Hello, and welcome. Over the next several chapters, we are going to embark on a detailed journey to explore one of humanity's most enduring and debated assets, gold. For thousands of years, this shimmering yellow metal has captivated kings, inspired explorers, fueled empires, and served as the ultimate symbol of wealth and power. From the tombs of the Egyptian pharaohs to the vaults of the world's most powerful central banks, gold has maintained a unique and revered place in our collective consciousness. But in the 21st century, a world of digital currencies, complex stock markets, and countless investment vehicles, a critical question arises, especially for Americans. Is gold still a good investment? Is it a wise addition to a modern financial portfolio? Or is it merely, as some critics have called it, a barbarous relic of a bygone era? Designed to tackle that very question from multiple angles, we will dissect the arguments for and against owning gold, explore its historical performance, examine the various ways you can invest in it, and discuss its potential role in your financial life. Our goal is not to tell you what to do, but to provide you with a comprehensive, balanced, and educational foundation so you can make your own informed decisions. A crucial disclaimer. Before we proceed, it is absolutely essential to state the following clearly. The information presented in this series is for educational and informational purposes only. It is not and should not be considered financial, investment, legal, or tax advice. The world of investing is complex and carries inherent risks. The value of gold can and does fluctuate, sometimes dramatically. Any decision to invest in gold or any other asset should be made only after consulting with a qualified and licensed financial advisor who can understand your individual circumstances, risk tolerance, and financial goals. This series is a starting point for your own research and due diligence, not a substitute for professional counsel. We are navigating a topic with a lot of history and opinion, and our aim is to present these facts and perspectives neutrally. Setting the stage. What is real money? To truly understand the debate around gold, we must first touch upon a fundamental concept: the nature of money itself. The US dollar in your wallet or your bank account is what's known as fiat currency. The word fiat is Latin for let it be done. Its value comes from the trust and confidence that people have in the government that issues it. It is not backed by a physical commodity. For most of human history, however, money was directly tied to something tangible and scarce, most often gold and silver. A dollar bill was essentially a claim check for a specific amount of gold held in a government vault. This was known as the gold standard. The United States officially abandoned the last vestiges of the gold standard in 1971. Since then, the US dollar, and indeed most global currencies, have been fiat. This distinction is the very heart of the argument for gold. Proponents believe that because gold is a physical, tangible asset with a limited supply, it holds an intrinsic value that cannot be diminished by government policy or money printing. In contrast, a government can, in theory, print an unlimited amount of its own currency, potentially devaluing it over time through inflation. This core idea, gold as real money versus government-issued currency, is a theme we will revisit time and again throughout this series. The enduring mystique. So why gold? Why not platinum or palladium, or some other rare material? Gold possesses a unique combination of characteristics that has made it the world's preferred store of value for millennia. It is chemically stable. It doesn't rust, tarnish, or corrode. An ounce of gold mined by the Romans 2,000 years ago is still an ounce of gold today. It is also highly divisible without losing its value. And it is portable. A significant amount of wealth can be stored and transported in a small physical space. But beyond its practical chemical properties, gold has a deep psychological and cultural pull. Its warm, lustrous glow is universally seen as beautiful. Throughout history, it has been synonymous with permanence, security, and prestige. This isn't just a financial calculation. It's a deeply ingrained human perception built over countless generations. When people feel uncertain about the future, when they lose faith in governments or financial systems, they have historically turned to the one asset that has outlasted every empire and every currency: gold. In this first chapter, our goal is simply to set the table. We are establishing the context for why gold is even a topic of discussion today. It isn't just another commodity like oil or corn. It occupies a unique space at the intersection of economics, history, and human psychology. It is both a raw material used in industry and dentistry, and a monetary asset held by central banks to stabilize their economies. As we move forward, we will leave the philosophical and dive deep into the practical. We will analyze the data, examine the trends, and hear from both the strongest advocates and the sharpest critics. We'll explore questions like: Does gold truly protect against inflation? How does it perform during stock market crashes or recessions? What are the differences between buying physical gold coins, investing in a gold ETF, or owning shares in a mining company? What are the costs and risks associated with each? The journey to understanding gold is a fascinating one. It forces us to ask big questions about what value really is, where we place our trust, and how we plan for a future that is, by its very nature, uncertain. Thank you for joining me for this introduction. In our next chapter, we will turn back the clock and take a closer look at gold's historical role as money, from ancient civilizations to the establishment of the US gold standard, to understand how the past continues to shape its value proposition today. Welcome back. In our opening chapter, we explored the timeless allure of gold and established the fundamental difference between tangible assets and modern fiat currency. To truly grasp why gold is still debated as a vital investment today, we must first understand its past. History is not just a collection of stories. It is the context that gives gold its perceived value. So now, let's take a journey through time to see how a simple, shiny metal became the bedrock of global economics for centuries. Gold's story as a symbol of value is as old as civilization itself. Ancient Egyptians considered gold to be the flesh of the gods, and reserved it for pharaohs, religious artifacts, and burial adornments. It represented divinity and eternity. But while it was highly valued, it wasn't yet money in the way we think of it. Early trade was dominated by barter systems, exchanging goods and services directly. The Great Leap Forward occurred around 600 BC in the Kingdom of Lydia, located in modern-day Turkey. The Lydians were the first to mint standardized coins of a specific weight and purity from a gold-silver alloy called electrum. This was a revolutionary innovation. For the first time, there was a medium of exchange that was portable, durable, divisible, and most importantly, uniform. A merchant no longer had to weigh and test the purity of a lump of gold for every transaction. The king's stamp on the coin guaranteed its value, dramatically simplifying and accelerating commerce across the ancient world. The concept was quickly adopted and refined by other empires. The Greeks and later, the Romans created vast monetary systems based on gold and silver coins. The Roman Empire's gold coin, the aureus, was a symbol of the empire's power and stability. It funded their legendary legions and massive infrastructure projects. However, the Romans also provided us with one of history's earliest and most important lessons in currency devaluation. As emperors faced mounting expenses and a shortage of precious metals, they began debasing their currency by secretly mixing in cheaper metals like copper, while keeping the coin's face value the same. People eventually caught on, lost faith in the currency, and inflation soared, contributing to the empire's eventual economic collapse. This historical example is a cornerstone of the argument for owning pure gold. The idea that it cannot be debased. Fast forward through the Middle Ages and into the Age of Exploration. The European powers' quest for gold was a primary driver of global exploration. Nations operated under an economic theory called mercantilism, which stated that a nation's power was directly measured by the amount of gold and silver in its treasury. This belief fueled Columbus's voyages to the Americas and the subsequent conquests by the Spanish conquistadors, all in a relentless pursuit of gold to enrich their home countries. By the 18th and 19th centuries, the world was ready for a more formalized system. Great Britain, then the world's dominant economic power, formally adopted the classical gold standard in 1821. This was the system in its purest form. The British pound was defined by a specific quantity of gold, and anyone holding banknotes could, in theory, exchange them for a corresponding amount of physical gold at any bank. This imposed a strict discipline on the government. It couldn't simply print more money to pay its bills. Its currency creation was limited by the amount of gold in its vaults. Many other major nations, including the United States, eventually followed suit. The United States officially adopted a form of the gold standard in the late 19th century. For decades, the US dollar was defined as being worth a specific fraction of an ounce of gold. This period, from the 1870s to the start of World War I, is often cited by proponents of the gold standard as an era of remarkable price stability and strong economic growth. However, the rigid discipline of the gold standard was also its biggest weakness. In times of crisis, like a major war or a severe economic depression, governments need financial flexibility. They need the ability to rapidly increase spending to fund armies, or to stimulate a failing economy. Being tied to a fixed amount of gold makes this incredibly difficult. Consequently, most countries, including the US, temporarily suspended their gold standards during World War I. The system was reinstated afterward, But the Great Depression of the 1930s dealt it a near-fatal blow. As the economy crumbled and people rushed to hoard gold, governments found themselves unable to fight the downturn. In 1933, President Franklin D. Roosevelt took the drastic step of making it illegal for U.S. citizens to privately own gold bullion, forcing them to turn it in to the government in exchange for paper dollars. The final act in the long history of the gold standard began after World War II. At the Bretton Woods Conference in 1944, the Allied nations established a new global economic order. Under this system, the U.S. dollar was crowned the world's reserve currency. The U.S. government promised to redeem its dollars for gold at a fixed rate of $35 per ounce, but only for foreign central banks, not for individuals. Other world currencies were then pegged to the U.S. dollar. This system worked for a while, but by the 1960s, it was under immense strain. The costs of the Vietnam War and expanding domestic social programs led the U.S. to print far more dollars than it could back with its gold reserves. Other countries, seeing this imbalance, began to lose faith and started demanding gold in exchange for their dollar holdings. The U.S. gold supply dwindled rapidly. The breaking point came on August 15, 1971. In a move that became known as the Nixon shock, President Richard Nixon announced that the United States would unilaterally and immediately close the gold window, ending the convertibility of U.S. dollars into gold. With that single act, the last official link between the world's major currencies and gold was severed. For the first time in millennia, the entire global financial system was based on pure fiat currencies, backed by nothing but faith in the governments that issued them. This historical journey brings us to the present day. Understanding this shift, from gold-backed money to a fiat system, is the single most important piece of context for our entire discussion. It is the reason why advocates for gold believe it is more essential than ever as a form of financial protection. In our next chapter, we will begin to unpack the first and most prominent argument for owning gold in our modern era: its role as a potential hedge against inflation, and the long-term devaluation of currency. Hello and welcome back. In our last chapter, we journeyed from ancient Lydia to the Nixon shock of 1971, tracing how gold evolved from a revered metal into the anchor of the global monetary system, and how that anchor was ultimately severed. That dramatic decision ushered in the modern era of fiat currency, where the value of money is determined by policy and public trust, not by a vault full of metal. This brings us directly to the single most powerful and frequently cited argument for owning gold today: its potential role as a hedge against inflation. So, what exactly is inflation? In the simplest terms, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of a currency is falling. Your dollar buys you less than it did yesterday. It's the silent thief that erodes the value of your savings over time. If you hide a $100 bill under your mattress, in 10 years, you will still have a $100 bill. But what that bill can buy, in terms of groceries, gas, or housing, will likely be significantly less. The argument for gold as an inflation hedge is intuitive and deeply rooted in the history we just discussed. The theory is this: because gold is a physical asset with a finite supply that cannot be created at will by a central bank, it tends to hold its value over the long term. Therefore, as the value of the US dollar decreases due to inflation, the number of dollars required to buy 1 ounce of gold should, in theory, increase. Put another way, gold's price in dollars should rise to compensate for the dollar's loss of purchasing power. The goal isn't just to have more dollars, it's to preserve your ability to purchase goods and services. Let's look at a well-known historical example that illustrates this concept. In the 1970s, after the US left the gold standard, the country experienced a prolonged period of high inflation, often called stagflation, a toxic mix of a stagnant economy and high inflation. During that decade, the purchasing power of the dollar plummeted. At the same time, the price of gold experienced a spectacular bull market, soaring from about $35 an ounce to over $800 at its peak in early 1980. For investors during that specific period, gold performed exceptionally well as a protector of wealth, while other assets struggled. This decade is the poster child for the pro-gold argument. However, and this is a critically important point for a balanced discussion, the relationship between gold and inflation is not a perfect, one-to-one correlation. Gold is not a magic bullet. There have been other periods of rising inflation where gold's performance has been lackluster. Likewise, there have been periods of low inflation where gold has performed very well due to other factors. So, what complicates this relationship? Several factors are at play. Interest rates are a major one. Gold is often in a tug-of-war with assets that provide yield, like government bonds. When interest rates are high and offer a good return, the opportunity cost of holding gold, which pays no interest or dividends, goes up. Why hold a non-yielding metal when you can earn a safe and attractive return from a bond? Conversely, when interest rates are very low, especially if they are lower than the rate of inflation, a situation known as negative real rates, gold often becomes much more attractive to investors. Investor sentiment and global uncertainty also play huge roles, which we will discuss in more detail in our next chapter. Fear, geopolitical tensions, or a lack of faith in government policies can drive investors toward gold, regardless of the current inflation rate. To think about this in another way, many proponents view gold not as a short-term trade against monthly inflation reports, but as a long-term preserver of purchasing power over decades or even centuries. There's a famous thought experiment that suggests an ounce of gold in Roman times could buy a fine toga and sandals, and today, a similar ounce of gold can still buy a high-quality men's suit and shoes. While the US dollar price of the suit has gone from a few dollars to hundreds or even thousands, the amount of gold required has remained remarkably stable. This isn't a scientific formula, of course, but an illustration of the core idea. Gold retains its purchasing power across vast stretches of time in a way that fiat currencies, by their very design, do not. In summary, the argument that gold acts as a hedge against inflation is compelling, particularly when viewed through a long-term lens and supported by dramatic historical episodes like the 1970s. The logic that a finite asset should hold its value as an infinite currency is created is sound. However, it is crucial for any potential investor to understand that in the shorter term, the correlation can be weak and unpredictable. Other powerful economic forces, like interest rates and market psychology, can and do override the influence of inflation on gold's price. This leads us to the other side of the protection coin. Gold isn't just seen as a shield against the slow, creeping erosion of inflation. It's also viewed by many as a safe haven asset, to be held during times of sudden crisis. In our next chapter, we will explore gold's role as a portfolio stabilizer during stock market crashes, recessions, and periods of intense geopolitical turmoil. Welcome back. In our last chapter, we examined the argument for gold as a long-term defense against the slow, steady erosion of purchasing power, known as inflation. Now we shift our focus from that creeping threat to the sudden shocks that can jolt the global economy: financial crises, recessions, and periods of intense geopolitical turmoil. In these moments, you will often hear financial commentators talk about a flight to safety, and one asset is consistently at the center of that conversation. This brings us to gold's second major role in a modern portfolio: its potential as a safe haven asset. What is a safe haven? A safe haven asset is an investment that is expected to retain or even increase in value during times of widespread market turbulence. When traditional assets like stocks and bonds are falling, investors, driven by fear and a desire to preserve their capital, seek refuge in assets they perceive as being more stable. For thousands of years, gold has been the quintessential safe haven. The psychology behind this is simple and powerful. In a crisis, confidence evaporates. Confidence in the stock market, confidence in corporate earnings, confidence in the banking system, and sometimes, even confidence in the government's ability to manage the situation. Gold's appeal in these moments comes from the fact that its value is not dependent on any of those things. It is a tangible, physical asset that you can hold in your hand. A gold coin has no CEO, no board of directors, and no quarterly earnings report. It carries no counterparty risk, meaning you aren't relying on another party or institution to fulfill a promise. A bond relies on the issuer not to default. A stock's value depends on the company's future success. Gold just is. This perception of being outside the system is what makes it so attractive when the system itself seems unstable. Let's look at how this has played out in some well-known historical events. The most prominent recent example is the 2008 global financial crisis. As major investment banks like Lehman Brothers collapsed and the global stock markets went into a freefall, fear gripped the financial world. While nearly every asset class was plummeting in value, gold began to perform its historical safe haven role. After an initial dip, as some investors sold everything to raise cash, gold began a powerful and sustained rally that would last for several years, reaching a then record high. Many investors who had allocated a portion of their portfolio to gold found that its gains helped to offset some of the devastating losses they were experiencing in their stock holdings. A similar pattern can be observed during other periods of economic stress, such as the dot-com bust of the early 2000s. As technology stocks collapsed, gold, which had been in a prolonged bear market for 2 decades, began a new long-term uptrend. These historical instances demonstrate why many view gold as a form of portfolio insurance. It is important, however, to introduce a point of nuance here. Gold is not guaranteed to immediately spike at the first sign of trouble. In a true liquidity crisis, when fear is at its absolute peak, investors may sell their profitable positions, including gold, to cover losses in other areas. This can cause a temporary dip in the gold price alongside other assets. But historically, what has often followed is a period where gold detaches from the broader market and begins to climb as the full extent of the crisis becomes clear and the flight to safety truly takes hold. Beyond economic crises, gold has also historically reacted to geopolitical instability. When tensions flare between major global powers, or when a significant conflict breaks out, a cloud of uncertainty hangs over the global economy. These events can disrupt trade, cause energy prices to spike, and shake confidence in international agreements and currencies. During such times, gold is often seen as a neutral, non-political store of value. It does not belong to any single country, and its value is recognized globally, making it a potential refuge when the value of national currencies comes into question. This brings us to a key investment concept: correlation. Correlation measures how two different assets move in relation to each other. Many stocks, for example, have a high positive correlation. When the overall market is up, they tend to go up together. The investment case for gold is often built on the idea that it has a low, or sometimes even negative, correlation with financial assets like stocks. This means it often zigs when the stock market zags. The principle of diversification is built on this very idea. By owning a mix of assets that don't all move in the same direction at the same time, an investor can potentially smooth out their portfolio's returns and reduce overall volatility. Because gold's price is influenced by a different set of factors, like interest rates, currency fluctuations, and investor fear, than those that drive stock prices, it can, in theory, provide a balancing effect to a portfolio that is heavily weighted toward traditional financial assets. In conclusion, gold's reputation as a safe haven is one of the most compelling arguments for its inclusion in a diversified portfolio. Its unique status as a tangible asset free from counterparty risk, combined with a historical tendency to perform well during periods of economic and geopolitical fear, makes it a powerful tool for potential risk management. While its performance is never guaranteed, history has repeatedly shown that when confidence in conventional financial systems falters, many investors around the world turn to the enduring security of gold. So far, we have discussed the major theoretical arguments for owning gold, as a hedge against inflation and as a safe haven in crises. But how does one actually go about investing in it? The options available today are far more varied than simply buying a chest of coins. In our next chapter, Chapter 5, we will begin to explore the how, the practical ways for an American to buy and own gold, starting with the most traditional method: physical bullion in the form of coins and bars. Welcome back. In our previous chapters, we've explored the historical and theoretical arguments for gold's place in an investment portfolio, its potential roles as an inflation hedge and a safe haven asset. We've focused on the why. Now we pivot to the how. For the next several chapters, we will delve into the practical ways an American investor can gain exposure to gold, starting with the oldest and most direct method of all: owning physical gold bullion. When we talk about bullion, we are referring to gold that is valued purely by its weight and purity, not by any rare or collectible features. This is investment-grade gold, and it primarily comes in two forms: coins and bars. For many who are drawn to gold, physical ownership is the only method they will consider, and the reasons for this are deeply compelling. The primary appeal is tangibility. In a world of digital account balances and complex financial instruments, physical gold is an asset you can see, touch, and hold. It is real. This provides a level of psychological comfort and security that no stock certificate or account statement ever can. Directly linked to this is the concept we've touched on before: the absence of counterparty risk. When you own a physical gold coin, its value is inherent in the metal itself. You are not depending on a bank to stay solvent, a fund manager to make wise decisions, or a company to remain profitable. The asset and its value are in your possession, completely independent of the wider financial system. For individuals who are skeptical of financial institutions or concerned about systemic risk, this is the most important feature. Let's first look at the most popular option for individual investors: gold coins. When you hear about gold coins, it's important to distinguish between common bullion coins and rare, numismatic coins. Our focus here is strictly on bullion. Numismatic coins are valued for their rarity, historical significance, and condition, a field for collectors and specialists. Bullion coins are valued for their gold content. In the United States, Some of the most well-known and trusted bullion coins include the American Gold Eagle and the American Gold Buffalo. Globally, other highly recognized coins are the Canadian Maple Leaf, the South African Krugerrand, and the Austrian Philharmonic. These coins are typically produced in various sizes, with the 1 troy ounce version being the most common. When you purchase a bullion coin, you will pay the current market price for the gold itself, known as the spot price, plus an additional amount called a premium. This premium covers the costs of manufacturing the coin, distributing it, and the dealer's profit. Premiums vary depending on the type of coin, its size, and the dealer you purchase it from. Generally, smaller coins carry higher percentage premiums than larger ones. The other major category of physical bullion is gold bars. Gold bars are produced by private refineries, with brands like PMP Suisse, Belcambi, and the Perth Mint being among the most reputable. They come in a much wider range of sizes than coins, from as small as a single gram to the large 400-ounce, good delivery bars held by central banks. The primary advantage of gold bars is that they typically have lower premiums than gold coins of the same weight. You are paying less for the manufacturing process, and more for the raw gold itself. For investors looking to acquire the most gold for their dollar, larger bars are often the most cost-effective method. However, this comes with a trade-off in terms of flexibility. A large 1 kilogram bar is efficient to buy, but it cannot be easily divided if you wish to sell only a portion of your holdings. In contrast, if you own 10 1-ounce coins, you can easily sell 1 or 2 at a time as your needs require. While the appeal of direct ownership is strong, it is crucial to consider the practical challenges and costs associated with physical gold. The most significant consideration is storage and security. If you decide to store your gold at home, you must invest in a high-quality, heavy-duty safe and take precautions to ensure your own security. The alternative is to pay for storage at a secure third-party depository or in a bank's safe deposit box. While these services offer professional security, they come with annual fees, and it's important to understand the terms of their insurance coverage and your access rights. This leads to the next cost: insurance. Whether stored at home or in a vault, your gold holdings should be properly insured against theft or loss, which is an ongoing expense that must be factored into the total cost of ownership. Finally, there are transaction costs. As we mentioned, you pay a premium when you buy. When you decide to sell, you will likely sell your gold back to a dealer for a price that is slightly below the spot price. The difference between the dealer's buying price and selling price is called the spread, and it is another cost of doing business in the physical bullion market. In summary, owning physical gold offers the ultimate intangible, direct ownership, completely outside the traditional financial system. It is the purest form of gold investing. However, this independence comes with a unique set of responsibilities and costs, including making arrangements for secure storage, insurance, and navigating the premiums and spreads involved in buying and selling. For those who are attracted to the idea of gold, but are hesitant to take on these logistical challenges, the modern financial world has created alternative solutions. In our next chapter, we will explore the most popular of these: paper gold, with a specific focus on gold exchange-traded funds, more commonly known as ETFs. Welcome back. In our last chapter, we explored the timeless appeal of owning physical gold bullion. We discussed the powerful sense of security that comes from holding a tangible asset, but we also acknowledged the real-world challenges of storage, insurance, and transaction costs. These practical hurdles led to the rise of financial innovations, designed to give investors exposure to gold's price movements without the need to handle the metal itself. This brings us into the world of paper gold, and its most popular and accessible form, the Gold Exchange-Traded Fund, or ETF. So what exactly is a gold ETF? An exchange-traded fund is a type of investment fund that can be bought and sold on a stock exchange, just like a share of a company like Apple or Ford. A gold ETF is specifically designed to do one thing: track the price of gold. Here's how it generally works. The company that creates and manages the ETF, known as the issuer, will purchase a very large quantity of physical gold bars. We're talking about tons of it. This gold is then stored in highly secure, audited vaults, often in major financial hubs like London or Zurich. The fund then issues shares, and the value of these shares is directly tied to the value of the gold held in the vault. When you buy a share of a gold ETF through a standard brokerage account, you are effectively buying a small, fractional ownership stake in that large pool of gold. The introduction of the first gold ETFs in the early 2000s was a revolutionary moment for gold investing. It democratized access to the asset class, and the reasons for their immense popularity highlight the advantages of this approach. First and foremost is convenience and liquidity.
Disclaimer: The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Buying or selling shares of a gold ETF is as simple as trading any other stock. It can be done online through a brokerage account in a matter of seconds during market hours. This stands in stark contrast to the process of finding a reputable dealer, arranging payment, and taking delivery or arranging for storage of physical coins or bars. The ease of transaction is, for many, the single biggest benefit. Second are the lower transaction costs. As we discussed, buying physical gold involves paying a significant premium over the spot price. Gold ETFs, on the other hand, trade at prices very close to the actual spot price of gold. The spread, which is the small difference between the buying and selling price, is typically just a few cents. This efficiency can make a significant difference, especially for those who might trade in and out of a position. Third is the elimination of storage and security concerns. The fund manager handles the enormous logistical and financial burden of storing, insuring, and auditing the physical gold. The investor doesn't need to buy a safe, pay for a safe deposit box, or take out a separate insurance policy. These costs are bundled into a small annual management fee. However, for all their convenience, gold ETFs represent a fundamental trade-off, and this is where we must discuss the cons, or criticisms. The primary drawback is the introduction of counterparty risk. With physical gold in your possession, you have zero counterparty risk. With an ETF, you are placing your trust in a chain of financial institutions. You trust the fund manager to properly manage the fund. You trust the custodian bank to safely store the gold without leasing it out. And you trust your brokerage firm to maintain the integrity of your account. You don't own the gold. You own a security that is a claim on the gold. This leads to the core philosophical argument made by physical gold advocates, which is often summarized by the phrase, "If you can't hold it, you don't own it." They argue that in a true catastrophic financial crisis, the very scenario where a safe haven asset is needed most, the complex web of claims and ownership in the paper market could break down. For the vast majority of retail investors, it's not possible to take their ETF shares and redeem them for a physical gold bar. That option is typically reserved only for very large, institutional investors trading in massive blocks of shares. Finally, there is the matter of ongoing fees. Every gold ETF charges an annual management fee, known as the expense ratio. This is usually a small percentage of your investment, but it is a recurring cost that you will pay every year you hold the fund. Over a long period, this fee can create a small but noticeable drag on your investment's performance when compared to holding physical gold, which has no management fees, although it does have its own storage and insurance costs to consider. In conclusion, gold ETFs are a modern, convenient, and cost-effective tool for gaining exposure to the price of gold. They have made gold investing accessible to millions. But they are a proxy for gold, not gold itself. The choice between a gold ETF and physical bullion boils down to a fundamental question of priorities. Is the unparalleled convenience and liquidity of an ETF worth the trade-off of giving up direct ownership and accepting the layers of counterparty risk inherent in the financial system? Of course, ETFs are not the only way to invest in gold through the stock market. An entirely different approach is to invest in the companies that bring the gold out of the ground. In our next chapter, we will explore the exciting and volatile world of gold mining stocks. Welcome back. In our last two chapters, we explored different ways to gain exposure to the price of gold itself, first through direct physical ownership, and then indirectly through financial instruments like gold ETFs. Now we are going to explore an entirely different approach, investing in the businesses that actually get the gold out of the ground. Welcome to the world of gold mining stocks. It is absolutely crucial to understand from the outset that buying a share in a mining company is fundamentally different from buying gold. A gold coin is a simple, passive asset. A gold mining company is an active, complex, and dynamic business. When you buy a mining stock, you are not buying gold. You are buying a share of ownership in a company, with all the opportunities and, more importantly, all the risks that come with running a business. So why would an investor choose this path? The single biggest reason is the potential for leverage. A mining stock's price can be highly leveraged to the price of gold, meaning a small change in the gold price can lead to a much larger change in the company's profitability and its stock price. Let's use a simplified, hypothetical example to illustrate this. Imagine a mining company can produce gold at an all-in sustaining cost, of $1,500 per ounce. If the market price of gold is $2,000, the company makes a profit of $500 per ounce. Now let's say the price of gold rises by 10% to $2,200. The company's cost remains the same at $1,500, but its profit per ounce jumps to $700. While the price of gold only went up 10%, the company's profit in this example went up by 40%. This explosive potential for profit growth is what attracts many investors to mining stocks, especially when they believe gold prices are heading higher. Furthermore, unlike gold itself, some established mining companies can provide a potential income stream. Profitable, well-managed miners often pay dividends to their shareholders. Lastly, a successful company can grow through its own efforts, by discovering a major new gold deposit or by improving its operational efficiency, potentially increasing its value even if the price of gold remains flat. However, and this is the most important part of this chapter, this potential for higher reward comes with a significantly higher and more complex set of risks. Let's be very clear. Investing in gold mining stocks is widely considered to be much riskier than investing in gold bullion. First, there are immense operational risks. Mining is a heavy industrial and often dangerous business. A mine could suffer a flood or a collapse, halting production indefinitely. Essential multi-million-dollar machinery can break down. Labor strikes can shut down operations for months. On top of that, the costs of fuel, electricity, and labor can rise unexpectedly, squeezing the company's profit margins. Second is geopolitical risk. Many of the world's richest gold deposits are in countries with unstable political environments. A foreign government could suddenly decide to increase mining taxes, revoke permits, or, in the most extreme cases, nationalize the mine, effectively seizing the asset from the company and its shareholders. This is a risk that is completely outside of the company's control. Third, there is geological risk. Mining companies spend enormous sums of money on exploration. They might drill hundreds of test holes based on promising geological data, only to find that the deposit is not large enough or rich enough to be mined profitably. Exploration is an inherently speculative endeavor. Fourth, like any business, there is management risk. A company's success is highly dependent on the quality of its leadership. A management team that takes on too much debt, makes a poor acquisition, or fails to manage its operations effectively can destroy shareholder value, even in a rising gold price environment. Finally, it is critical to remember that mining stocks are still stocks. They trade on the stock market and are subject to the same broad market sentiment as any other company. In a major market crash, it's not uncommon to see mining stocks get sold off heavily along with everything else, even if the price of gold itself is stable or rising. They are part of the financial system, not an asset outside of it. The mining sector itself is diverse, ranging from large senior producers that operate multiple mines across the globe, to small, highly speculative junior explorers, whose main asset is just a piece of land with the potential for a discovery. There are also royalty and streaming companies, which have a different business model of financing mines rather than operating them. Each carries its own distinct risk profile. In conclusion, gold mining stocks offer a way to invest in the gold sector with the potential for leveraged gains and dividends. However, they are not a direct proxy for the gold price. They are a wager on a company's ability to navigate a minefield of operational, geopolitical, and financial risks in the complex business of extracting value from the earth. So far in our series, we have focused primarily on the reasons for considering gold. To ensure a truly balanced perspective, our next chapter will be dedicated entirely to the other side of the argument. We will explore the strong and valid criticisms against gold as an investment. Welcome back. Thus far in our series, we have dedicated significant time to understanding the historical appeal of gold, the arguments for its inclusion in a portfolio, and the various ways one can invest in it. We have explored the bull case, the reasons for optimism. However, a responsible and complete education requires that we give equal weight to the other side of the debate. To do that, we must now step into the shoes of the skeptic and explore the powerful and persuasive arguments against investing in gold. This is the bear case. The first and perhaps most potent criticism leveled against gold, famously articulated by some of the world's most successful investors like Warren Buffett, is that gold is an unproductive asset. Think about what that means. A bar of gold sitting in a vault will still be a single bar of gold a year from now, 50 years from now, and a century from now. It doesn't create anything. It doesn't generate earnings, pay interest, or produce a cash flow. Its value is entirely passive. Now, contrast that with other major asset classes. When you buy a stock, you are buying a piece of a business. That business has employees, machinery, and ideas. It sells goods or services, generates revenue, and aims to grow its profits over time. A successful business can reinvest those profits to expand, innovate, and become even more valuable. It may also distribute some of its profits to you, the owner, in the form of dividends. A business is a productive, dynamic entity. Similarly, a bond is essentially a loan that pays you a regular stream of interest payments. A piece of investment real estate can be rented out to generate monthly income. Gold does none of these things. The only way to make money from gold is to sell it to someone else for a higher price than you paid. This is entirely dependent on market sentiment and demand. Proponents call this preserving purchasing power, but critics argue it relies on a form of the greater fool theory. The idea that you can profit because someone else will come along who is willing to pay more. From this perspective, gold is not an investment in value creation, but a speculation on price appreciation. The second major argument is that gold's value is not based on any real economic utility, leading some to call it a barbarous relic, a phrase coined by the influential economist John Maynard Keynes. This critique suggests that gold's revered status is purely a matter of historical tradition and human psychology, not modern economic reality. Unlike other commodities, gold has limited industrial use. Oil and natural gas power our world. Copper is essential for wiring and electronics. Lumber builds our homes. While gold is used in dentistry and some high-end electronics, these uses represent only a small fraction of its total demand. The vast majority of gold sits in vaults or is worn as jewelry. Therefore, critics argue, its high price is a social construct, a bubble based on a collective belief that could in theory fade over time, causing its value to collapse. Third, despite its reputation as a safe asset, gold can be extremely volatile and deliver poor long-term returns. The price of gold can and does experience dramatic swings and prolonged bear markets. For example, after a massive run-up, gold hit a peak of around $800 per ounce in January of 1980. After that, its price fell and then languished for more than 2 decades. In inflation-adjusted terms, an investor who bought at that 1980 peak would have had to wait nearly 30 years just to get back to even. This historical example demonstrates that gold is far from a guaranteed protector of wealth in all circumstances. It is not a stable, steady investment. It is a volatile commodity whose price can remain stagnant for very long periods, severely underperforming other asset classes like stocks. Finally, as we've touched upon before, there are the undeniable costs of ownership. These act as a constant drag on your potential returns. If you own physical gold, you have to account for the premiums you pay when you buy, the lower price you receive when you sell, and the ongoing costs of secure storage and insurance. If you opt for a gold ETF, you pay an annual management fee that, year after year, eats away at the value of your holding. Productive assets like dividend-paying stocks or interest-bearing bonds pay you to own them. With gold, you must often pay to own it. In summary, the case against gold is built on 4 main pillars. It produces no income and has no yield. Its value is based on sentiment rather than utility. Its price can be highly volatile and is capable of underperforming for decades at a time. And it comes with carrying costs that erode its value. These are substantial and well-reasoned arguments that anyone considering an investment in gold must carefully weigh. Now that we have thoroughly examined both the bull case and the bear case, the pros and the cons, we can move forward with a balanced perspective. In our next chapter, we will explore how these competing ideas come together in practice, by discussing the concept of asset allocation, and the specific role gold might play as a diversification tool within a modern portfolio. Welcome back. In our last chapter, we confronted the powerful arguments against gold, viewing it as an unproductive, volatile asset with high ownership costs. We have now officially heard from both the bulls and the bears. We've examined the case for gold as a protector against inflation and crisis, and the case against it as a relic with no real utility. So, where does that leave a prudent, modern investor? The answer, for many, lies not in choosing one side over the other, but in understanding a crucial investment principle: asset allocation. Asset allocation is the practice of dividing your investment portfolio among different categories of assets, such as stocks, bonds, real estate, and commodities like gold. The core idea is that different asset classes have different risk and return characteristics, and they don't all move in the same direction at the same time. The goal of asset allocation isn't necessarily to pick the single best investment, but to build a balanced, resilient portfolio that can perform reasonably well across a wide range of economic conditions. This leads us to the single most important concept in this chapter: diversification. You have almost certainly heard the old saying, Don't put all your eggs in one basket. That is the essence of diversification. By spreading your investments across various assets that are not perfectly correlated, you can potentially reduce the overall volatility and risk of your portfolio. Imagine a portfolio that is 100% invested in the stock market. During a strong economic expansion, that portfolio might perform spectacularly. But during a recession or a market crash, its value could fall dramatically. Now imagine a portfolio that also includes bonds. Bonds often perform differently than stocks. In a recession, for example, central banks might lower interest rates, which typically causes the value of existing bonds to rise, helping to offset some of the losses from the stock portion of the portfolio. This is where gold enters the modern portfolio conversation. The primary argument for including gold, even among investors who acknowledge its flaws, is its potential as a powerful diversification tool. As we've discussed, the factors that drive the price of gold are often very different from the factors that drive the prices of stocks and bonds. Stock prices are largely driven by corporate earnings, economic growth, and investor sentiment about the future of business. Bond prices are highly sensitive to interest rates and inflation expectations. Gold, on the other hand, often marches to the beat of a different drum. Its price can be driven by a loss of faith in fiat currencies, geopolitical fear, central bank buying, or a flight to safety during a crisis. Because of this, gold has historically shown a very low, and sometimes negative, correlation to stocks and bonds over long periods. In simple terms, it often zigs when other assets zag. Think of it as building a well-rounded team. You need players on offense who can score points. These are your growth assets, like stocks. But you also need players on defense who can protect your lead when the other team attacks. These can be your defensive assets, like high-quality bonds, and as proponents argue, gold. Gold might not be the star player that generates the highest returns year after year. Instead, its role is to be a stabilizer. It's the portfolio insurance that may underperform during the good times, but could potentially protect your overall wealth during the bad times. This brings us to a practical question. If an investor decides to include gold for diversification, how much is appropriate? This is a topic of much debate, and it is here we must again emphasize our educational purpose. We are not providing investment advice. However, we can observe what many financial professionals who advocate for gold typically suggest. They rarely, if ever, suggest a large allocation. Instead, gold is most often viewed as a small, strategic holding. It's common to see suggested allocations in the modest range of 2% to 10% of a total portfolio. The idea is to have enough to make a meaningful difference in a crisis, but not so much that its lack of yield becomes a major drag on the portfolio's overall performance during normal economic times. The exact percentage, if any, is a deeply personal decision that depends entirely on an individual's financial situation, long-term goals, and tolerance for risk. This is a decision that should only be made after careful research and consultation with a qualified, licensed financial advisor. In conclusion, after weighing all the pros and cons, the most compelling modern case for gold is not as a primary engine of wealth creation, but as a unique and uncorrelated component of a broadly diversified investment strategy. Its value may lie less in what it earns, and more in how it behaves when other parts of your portfolio are under stress. We have now covered the why, the how, the pros, the cons, and the potential role of gold. But there is one more critical, practical aspect we must address for any U.S. investor: taxes. How the government treats your investment gains can have a significant impact on your final returns. In our next chapter, Chapter 10, we will delve into the specific tax implications of owning and selling gold in the United States. Welcome back. We have journeyed through the reasons for owning gold, the various methods of doing so, the strong arguments against it, and its potential role in a diversified portfolio. We now arrive at one of the most practical and inescapable aspects of any investment: taxes. How your gains are taxed can have a profound impact on your overall returns. And when it comes to gold, the rules are unique and often surprising to new investors. Before we proceed, we must issue our most important disclaimer of this entire series. The information presented in this chapter is for general educational and informational purposes only. It is absolutely not legal or tax advice. Tax laws are incredibly complex, subject to change, and depend entirely on your individual financial situation. For any and all questions regarding your personal tax obligations, it is essential that you consult with a qualified and licensed tax professional, such as a certified public accountant or CPA. With that vital understanding in place, let's explore how the Internal Revenue Service, or IRS, generally views gold investments. For tax purposes, the IRS places physical gold bullion, and many of the financial products tied to it, into a special category. It is not treated like a stock, a bond, or a mutual fund. Instead, the IRS classifies gold as a collectible. This category also includes items like fine art, antiques, rare stamps, and gems. This classification is the single most important thing to understand, as it dictates a completely different and typically less favorable tax treatment. To appreciate the difference, let's quickly review how a standard investment like a stock is taxed. When you sell a stock for a profit, the gain is considered a capital gain. If you hold the stock for 1 year or less, it's a short-term capital gain, taxed at your ordinary income tax rate. However, if you hold it for more than 1 year, it qualifies as a long-term capital gain, which is taxed at much lower preferential rates, 0%, 15%, or 20% for most federal taxpayers, depending on their income. Here is the crucial distinction. Because gold is classified as a collectible, the favorable long-term capital gains rates do not apply. Instead, long-term capital gains on collectibles are taxed at a special, higher maximum federal rate of 28%. If your ordinary income tax bracket is lower than 28%, you'll pay that lower rate. But if you are in a higher tax bracket, your gain will be taxed at the 28% rate, not the 15% or 20% rate you might be accustomed to with stocks. Let's illustrate with a simple, hypothetical example. Suppose you are in the 24% federal income tax bracket. If you sell a stock you've held for 2 years and realize a $1,000 profit, you would typically pay the 15% long-term capital gains rate, which amounts to $150 in tax. Now, suppose you sell a gold coin you've held for 2 years for the same $1,000 profit. Because it's a collectible, your gain would be taxed at your ordinary rate of 24%, resulting in a $240 tax bill. That's a significant difference that directly impacts your net return. This collectibles tax generally applies to the most common forms of gold investment we've discussed. It applies to physical bullion like coins and bars. It also applies to the shares of most physically backed gold ETFs, which are typically structured in a way that the IRS treats them as if you own the gold directly. However, there is a major exception: gold mining stocks. Because you are buying shares in an operating business, not the metal itself, the IRS does not treat them as collectibles. Gains from selling gold mining stocks are subject to the standard capital gains rules. This means if you hold a mining stock for more than a year, your profits are eligible for the lower 0%, 15%, or 20% long-term capital gains rates. This distinction in tax treatment is a significant strategic factor for investors to consider when choosing how to gain exposure to the gold market. Finally, it's important to be aware of reporting requirements. The U.S. government requires diligent tax reporting. When you sell certain types of bullion products in specific quantities to a dealer, that dealer may be required by law to file a Form 1099-B with the IRS, reporting the details of the transaction. Regardless of whether a form is filed, it is always the individual's responsibility to keep accurate records of their purchase date and cost basis, and to report any and all capital gains to the IRS when they file their taxes. To summarize, the tax implications of owning gold are a serious consideration. The classification of gold as a collectible by the IRS means that long-term gains are taxed at a substantially higher rate than they are for traditional stock investments. This potential tax liability is a significant drawback that must be factored into any decision. Once again, these rules are complex, and we strongly urge you to discuss your specific situation with a qualified tax professional. Now that we have covered this critical aspect, we will turn to some final practical considerations. In our next chapter, Chapter 11, we will discuss the nuts and bolts of buying and selling physical gold, how to choose a reputable dealer, and the common pitfalls to avoid. Welcome back. After exploring the theories, the strategies, and the critical tax implications of gold ownership, we now turn to the most tangible part of the process: the act of actually buying and selling physical gold. Navigating the marketplace for the first time can feel intimidating, but by understanding the landscape and learning to recognize the signs of a reputable dealer, you can approach the process with confidence. This chapter is designed to be an educational guide on common practices and potential pitfalls. It is not an endorsement or recommendation of any specific company or method of purchase. As always, conducting your own thorough due diligence is paramount. So, where do people actually buy gold bullion? There are several common channels. The most popular in the digital age are the large online bullion dealers. These companies operate nationwide, offering a wide selection of coins and bars from around the world. Their advantages often include competitive pricing due to their high volume, and a wealth of educational resources on their websites. The main consideration here is, of course, that your product must be shipped to you, so understanding their shipping and insurance policies is critical. The more traditional route is a local coin shop. The primary benefit of a local dealer is the ability to see the products firsthand before you buy, pay in person, and walk away with your purchase immediately, eliminating shipping risks. You can also build a personal relationship with a dealer, who can become a valuable source of information. The potential downsides can be a smaller selection and sometimes slightly higher premiums compared to the large online dealers. It's also important to discuss places that can be high risk for new buyers. Generally, it is wise to be extremely cautious when considering buying investment-grade bullion from peer-to-peer marketplaces, online auction sites, or pawn shops. While legitimate sales can occur, these channels have a much higher risk of encountering counterfeit products or dealing with unvetted sellers. And be particularly wary of any unsolicited phone calls or high-pressure telemarketers offering once-in-a-lifetime deals on gold. Regardless of whether you choose an online or local dealer, the criteria for judging their reputation are the same. Here are some key things to look for. First is transparent pricing. A reputable dealer will clearly display both their buy price, what they'll pay you, and their sell price, what you'll pay them, for each product. These prices should update in near real time with the fluctuating spot price of gold. There should be no hidden fees. Second is reputation and longevity. How long has this company been in business? A long and positive track record is a good sign. Look for independent reviews from various sources. Check their rating with organizations like the Better Business Bureau. See what other customers are saying in independent online forums. Third, and this is a crucial distinction, is an educational versus a high-pressure sales approach. A good dealer should be a source of information. They should be willing to answer your questions about the difference between a gold eagle and a maple leaf without pushing you toward a specific product. Be wary of any salesperson who creates a false sense of urgency, suggests they have secret information, or tries to steer you away from standard bullion and towards so-called rare or numismatic coins with very high markups. This leads us to some common pitfalls to avoid. The most frequent is the bait-and-switch tactic. This is where a seller advertises a very low price on a common 1-ounce bullion coin, but when you contact them, they spend all their energy trying to convince you to buy a different, better product, often a pre-1933 European coin, or a limited edition commemorative medal, at a premium that is 30, 50, or even 100% over its actual gold value. Remember the distinction we made in an earlier chapter. Bullion is for investing in gold's value. Numismatics are for collectors, which is a very different field. Another red flag is any claim about confiscation-proof gold. Some sellers will use the history of the 1933 gold confiscation in the US to argue that certain types of coins are exempt and cannot be seized by the government. This claim is purely speculative, and is often used to justify charging enormous premiums for otherwise common historical coins. The process of selling your gold is essentially the reverse of buying. A reputable dealer will have a clear buyback policy. You will need to provide proper identification, and they will typically test the items to verify their authenticity and purity before making payment. You should expect to receive a price that is slightly below the current spot price of gold. In conclusion, the key to safely buying and selling physical gold is to be an informed consumer. Take your time, do your research, and choose a dealer with a long, transparent, and reputable history. Your best defense against a bad deal is your own knowledge. We have now covered the world of gold in significant detail. But gold is not the only precious metal that captures investors' attention. In our next chapter, we will briefly turn our focus to its well-known sibling, silver, and explore the key differences between these two monetary metals. Welcome back. Throughout this series, our focus has been squarely on gold. But it's impossible to have a complete conversation about precious metals without discussing its closest, and often more volatile, sibling, silver. For millennia, gold and silver have moved through history together as the world's primary forms of money, but in the modern era, their paths have diverged, giving them distinct characteristics as investments. This chapter is dedicated to exploring that sibling rivalry, comparing and contrasting these two monetary metals. The most fundamental difference between gold and silver today lies in their primary sources of demand. Gold, as we've established, is overwhelmingly a monetary metal. The vast majority of all the gold ever mined still exists today, held as a store of value in the form of central bank reserves, investment bars, coins, and jewelry. Its industrial use is relatively small. Gold's value is primarily driven by fear, inflation expectations, and its reputation as the ultimate safe haven asset. Silver, on the other hand, is a hybrid metal. It has one foot in the monetary world and the other planted firmly in the industrial world. While it is still held as an investment in coin and bar form, more than half of silver's annual demand comes from industrial applications. This is because silver possesses unique properties.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It has the highest electrical and thermal conductivity of any element, and it has powerful antimicrobial qualities. This industrial demand is not just for old-world technologies. It is at the very heart of the green energy and high-tech revolutions. Silver is an irreplaceable component in the manufacturing of solar panels, where it acts as a conductive paste to transfer electricity. It is essential in electric vehicles, which use significantly more silver than traditional cars for their complex wiring, battery connections, and advanced electronics. Its superior conductivity also makes it vital for 5G mobile technology, semiconductors, and countless other electronic devices. This industrial demand ties silver's fate not just to investor sentiment, but also to the health and growth of the global economy. This dual nature is the main reason why silver is typically much more volatile than gold. Its price is a push and pull between monetary and industrial forces. During an economic boom, industrial demand for silver might surge, pushing its price higher. During a recession, that same demand can collapse, putting severe downward pressure on its price. This often leads to much larger percentage price swings in silver compared to gold. Market analysts sometimes refer to silver as gold on steroids, a phrase meant to capture its tendency for more dramatic moves, both to the upside and the downside. This dynamic relationship is often tracked by a metric known as the gold-to-silver ratio. This is a simple calculation: the price of 1 ounce of gold divided by the price of 1 ounce of silver. The resulting number tells you how many ounces of silver it takes to buy 1 ounce of gold. This ratio has fluctuated wildly through history, from as low as 15 to 1 in ancient times to over 100 to 1 during periods of economic stress. Some market observers use this ratio as an analytical tool, suggesting that when the ratio is historically high, silver might be undervalued relative to gold, and when it is historically low, it might be overvalued. However, this is simply an observational tool, and its predictive value is a subject of constant debate. Another key difference is simply affordability. With gold prices in the thousands of dollars per ounce, silver, at a fraction of that cost, is far more accessible to investors with less capital. Purchasing a 1 ounce silver coin is a common entry point for those looking to begin owning physical precious metals. The trade-off, however, is storage density. Because of its much lower value per ounce, storing a significant amount of wealth in silver requires vastly more physical space and weight than storing the equivalent value in gold. Finally, it's important to note one key similarity for U.S. investors: taxation. Just like gold, the IRS classifies silver as a collectible. This means it is subject to the same less favorable tax treatment, with long-term capital gains being taxed at a maximum federal rate of 28%. In conclusion, while they are often spoken of in the same breath, gold and silver are not interchangeable. Gold is the quintessential monetary asset, a pure play on currency debasement and a flight to safety. Silver is a more complex, hybrid asset, influenced by both investment demand and the cycles of industrial production. It offers a lower price point and different demand drivers, but with the trade-off of significantly higher volatility. Having now compared these two metals, it's time to zoom out from the individual investor's perspective and look at the giants that move the market. In our next chapter, Chapter 13, we will explore the immense influence of central banks and large institutional players on the global price of gold. Welcome back. So far in our journey, we have viewed the world of gold primarily through the lens of an individual American investor. But to truly understand the forces that move the global gold price, we must now zoom out and look at the largest players in the market. The entities so large they are like whales in the ocean. Their movements can create currents that affect everyone else. These whales are the world's central banks. A central bank, like the Federal Reserve in the United States, is the institution responsible for managing a nation's currency and monetary policy. It is the very heart of the modern fiat money system. This raises a fascinating and critical question. Why do these creators of modern money continue to hold thousands of metric tons of ancient money, gold, in their vaults? The answer reveals the ultimate role gold plays on the world stage. For a central bank, Gold is a premier reserve asset. A country's reserves are its savings, used to ensure the stability of its own currency and to meet its international obligations. While these reserves are mostly made up of foreign currencies, primarily the US dollar, gold plays a unique and vital role for several key reasons. First and foremost, gold offers safety and has no counterparty risk. When a country holds US dollars, it is holding a claim on the US government. Its value depends on the continued strength and stability of the US economy and its policies. Gold, however, is a physical asset that is a claim on no one. It is a store of value that is independent of any single country's political or economic fortunes, making it the ultimate safe haven asset for a nation's wealth. Second, gold serves as a powerful tool for diversification. In recent decades, the world's financial system has been dominated by the US dollar. For many countries, this creates a dependency and a concentration of risk. By systematically adding gold to their reserves, central banks can diversify away from the dollar, a trend often referred to as de-dollarization. Gold is a neutral, universally accepted monetary asset that allows them to increase their financial sovereignty. Historically, the behavior of central banks has varied. For much of the 1990s and early 2000s, many Western European central banks were net sellers of gold. They viewed it as a legacy asset generating no return. However, the 2008 global financial crisis triggered a profound and historic shift in this behavior. Since that crisis, central banks around the world have transformed into massive and consistent net buyers of gold. This buying has been overwhelmingly led by emerging market nations. Countries like China, Russia, Turkey, and India have been at the forefront of this trend, steadily accumulating hundreds of tons of gold year after year. This sustained official buying creates a huge and relatively stable source of demand in the global market. Many market analysts believe this consistent central bank purchasing has created a soft floor under the gold price, providing support during periods when individual investment demand might be weaker. Beyond the official actions of central banks, we must also acknowledge the immense influence of private cultural demand, especially from the two population giants of Asia, China and India. In India, gold is deeply woven into the fabric of culture, tradition, and religion. The demand for gold jewelry is immense, particularly during the wedding season and major festivals like Diwali and Akshaya Tritiya. For hundreds of millions of Indian citizens, gold is the primary and most trusted form of savings and intergenerational wealth transfer. Similarly, in China, which is both the world's largest gold producer and consumer, a rapidly growing middle class has a strong cultural affinity for gold as a store of wealth. This creates a massive and ongoing source of physical demand from a population of over 1 billion people, in addition to the official purchases made by the People's Bank of China. In conclusion, the individual investor is just one part of a vast and complex global gold market. The largest and most influential players are the world's central banks, whose strategic decisions to buy gold are driven by a deep-seated desire for safety, diversification away from the US dollar, and financial independence. When you combine this powerful official demand with the immense and enduring cultural demand from the citizens of India and China, you can see the formidable macroeconomic forces that underpin the value of gold on the world stage. We have now examined gold from almost every angle: its history, its pros and cons, the methods of ownership, its role in a portfolio, and the major players in the market. In our next chapter, we will look to the horizon and explore the future of gold in an increasingly complex world of digital currencies and evolving geopolitical challenges. Welcome back. We have journeyed through millennia of gold's history, dissected its modern investment case, and weighed the intricate details of ownership. Now, in our penultimate chapter, we turn our gaze to the horizon. What does the future hold for this ancient metal in a world that is changing at an exponential pace? This is not an exercise in prediction, but an exploration of the massive, intersecting trends that analysts believe will shape gold's role for decades to come. The first great trend is the rise of digital money. This is unfolding on two separate fronts. On one side, you have decentralized cryptocurrencies, with Bitcoin being the most well-known. Proponents of Bitcoin have labeled it digital gold, pointing to its finite supply and its existence outside the control of governments and central banks. They see it as a modern, technologically superior alternative to the yellow metal. On the other side of that argument, critics highlight its extreme price volatility, its relatively brief and untested history, and ongoing security concerns, questioning whether it can truly be a reliable store of value in the same way gold has been for thousands of years. The debate between digital gold and the original gold is one that will likely intensify. On the other front are central bank digital currencies, or CBDCs. A CBDC is a digital version of a country's fiat money. A digital dollar, for instance, issued and controlled directly by the central bank. As governments around the world, though not currently the US, explore this technology, it raises profound questions. Some observers believe a world with CBDCs could increase demand for physical gold. They argue that programmable money and the end of physical cash could lead to a complete loss of financial privacy and an unprecedented level of government control over individual transactions. In such a world, gold's status as a private, anonymous, non-digital, and untraceable asset held completely outside the system could become more valuable than ever. The second monumental trend is the global debt supercycle. As of the mid-2020s, sovereign debt levels in the United States and many other developed nations are at or near historic highs, far surpassing levels seen even after World War II. This unprecedented mountain of debt presents a difficult long-term challenge. Many economists and market analysts believe that, eventually, governments may be tempted to deal with this debt through policies that lead to significant currency debasement, essentially, inflating away the value of their debt by creating more money. Proponents of gold see this as perhaps the single most powerful long-term tailwind for the metal. They argue that as the purchasing power of debt-based fiat currencies is intentionally eroded, the value of a finite, debt-free asset like gold will inevitably rise. The third and final trend is the accelerating shift in the geopolitical landscape. As we discussed in the last chapter, the world is moving from a unipolar, U.S. dollar-dominated system to a multipolar world with several centers of economic and political power. This shift is fueling a powerful movement among the world's central banks known as de-dollarization, a conscious effort to reduce their dependence on the US dollar for their reserves and for international trade. What asset are they turning to as they diversify? Overwhelmingly, it is gold. Gold is the only monetary asset that is universally accepted, politically neutral, and not simultaneously another country's liability. It is the perfect settlement asset for a multipolar world. The sustained large-scale buying of gold by the world's central banks is not just a passing trend. It is a long-term, strategic realignment of the global monetary order. This structural shift is perhaps the most significant force supporting the potential for gold's role to increase in importance on the world stage. In conclusion, while no one can know the future, the coming decades will be defined by the interplay of these three immense forces: the revolution in money, the consequences of historic debt, and the rebalancing of global power. Each of these trends, in its own way, presents a compelling case that gold's ancient roles, as a private store of value, as a hedge against currency debasement, and as a neutral monetary anchor, may not be fading into history, but may in fact become more relevant than ever. We have now reached the end of our analytical journey. In our final chapter, we will bring everything together, summarizing the key arguments for and against gold, and providing a final, balanced framework to help you continue your own educational journey. Welcome to the final chapter of our comprehensive journey into the world of gold. Over the last 2.5 hours, we have traveled from the mints of ancient Lydia to the digital frontiers of the 21st century. We've explored gold's historic role as money, dissected the modern arguments for and against it, examined the practical methods of ownership, navigated the complexities of US tax law, and looked at the global forces shaping its future. The goal of this final chapter is to bring all of these threads together, to synthesize everything we've learned, and to provide a balanced framework for you to use in your own ongoing financial education. So, after all this discussion, is gold a good investment for Americans? The only intellectually honest answer is, it depends. It depends on your perspective, your financial goals, your time horizon, and your view of the future. Let's briefly recap the powerful, competing arguments we've covered. First, the bull case, the arguments for gold. This perspective is built on gold's unparalleled history as a store of value, a form of real money that has outlasted every fiat currency ever created. Proponents see it as a vital hedge against the long-term certainty of inflation and the debasement of currency. They value its role as the ultimate safe haven asset, a form of financial insurance that can potentially protect wealth during stock market crashes, recessions, and periods of intense geopolitical fear. Finally, they point to its low correlation with stocks and bonds, arguing that a small allocation to gold can provide powerful diversification benefits, making an entire portfolio more resilient. On the other side of the ledger is the equally compelling bear case, the arguments against gold. This view, held by many successful investors, is centered on the fact that gold is an unproductive asset. It pays no interest, offers no dividends, and generates no cash flow. Its value is entirely dependent on what someone else is willing to pay for it in the future. Critics also point to its significant price volatility and the long, punishing bear markets it has endured, which challenge its reputation as a stable asset. Lastly, there are the practical and financial drawbacks. The costs of buying, selling, storing, and insuring it, and for U.S. investors, its unfavorable tax treatment as a collectible, which can significantly reduce net returns. So how does one reconcile these two valid but opposing viewpoints? Perhaps the best way is to see the decision not as a simple yes or no, but as a reflection of one's own financial philosophy. On one end of the spectrum, there are investors who have complete faith in human ingenuity, the growth of productive businesses, and the stability of the modern financial system. For them, a non-yielding asset like gold has little to no place in a portfolio geared for growth. On the other end, there are investors who are deeply skeptical of the global financial system's reliance on historic levels of debt and continuous money creation. For them, gold is not just an investment. It is an essential and non-negotiable form of protection against potential systemic failure. And in the vast middle ground are the pragmatists. These are the investors who may believe in the long-term growth of the stock market, but also recognize that history is filled with unexpected crises. For them, owning a small allocation of gold is a pragmatic diversification strategy, a modest price to pay for a form of portfolio insurance that they hope they will never need. The purpose of this entire audio series was never to tell you which of these camps is right. It was not to provide you with an answer. The purpose was to provide you with the knowledge, the context, and the vocabulary to ask better questions, to critically evaluate the claims made by both sides, and to understand the forces at play so you can confidently continue your own research. We will end where we began, with our most important message. This series has been for educational and informational purposes only. It is not and should not be taken as financial, investment, legal, or tax advice. The world of investing is complex, and all investments carry risks. Your financial journey is uniquely your own. The most valuable investment you can ever make is in your own education. Continue to read, to learn, and to ask questions. And most importantly, before making any decision that affects your financial well-being, please seek the guidance of a qualified, licensed financial advisor and a tax professional who can understand your personal situation and help you navigate your path forward. Thank you for joining me on this journey.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.